Hello friends, welcome back to our channel. I hope you are doing well. Tell me, are you searching for the best Kotak Equity Mutual Funds for 2026? Then you are at the right place, because today I have broken down the top 5 Kotak Equity Mutual Funds that truly stand out. But before we start, a quick disclaimer. Mutual fund investments are subject to market risks. Please read all scheme-related documents carefully before investing. Past performance is not indicative of future results. This video is for educational purposes only, not financial advice. Here's what we'll uncover together. The top 5 Kotak Equity Mutual Funds, key details about each scheme, their CAGR returns compared with benchmarks, important risk ratios, and finally, our long-term outlook. So stay with me till the end. You will get a complete picture. Friends, here are the top 5 Kotak Equity Mutual Funds as per the AUM and as on March 2026. First, Kotak Midcap Fund. Second, Kotak Flexicap Fund. Third, Kotak Large and Midcap Fund. Fourth, Kotak Multicap Fund. And fifth, Kotak Small Cap Fund. Before moving forward into detailed analysis, let me remind you, don't forget to like, share and subscribe. Your support helps us bring more finance-related topics to you and ensure you never miss our latest insights.
Let's begin with Kotak Midcap Fund. AUM 55,675 crore rupees. Kotak Midcap Fund has GE Vernova T&D, Fortis Healthcare, Ipca Laboratories, Emphasis, and KEI Industries as their top 5 stock holdings. CAGR returns of direct plan growth option are for 1 year 4.29%, 3 year 19.25%, 5 year 17.61%. Compared to the benchmark, Nifty Midcap 150 TRI are for 1 year 2.27%, 3 year 20.34%, 5 year 17.50%. Also, it stays true to its mandate with a dominant mid-cap exposure. Its portfolio is more tilted towards finance, IT and healthcare, offering a mix of growth and defensive sectors. Over 5 years, it has slightly outperformed its benchmark, proving its strength as a long-term compounder. While the 3-year performance is marginally below the benchmark, the fund has delivered consistent alpha in the 1 and 5-year horizons. Next, Kotak Flexicap Fund. AUM 50,146 crore rupees. Kotak Flexicap Fund has Bharat Electronics, HDFC Bank, ICICI Bank, State Bank of India, and Jindal Steel and Power as their top 5 holdings. CAGR returns of direct plan growth option are for 1 year minus 0.12%, 3 year 14.04%, 5 year 12.25%. Compared to the benchmark, Nifty 500 TRI are for 1 year minus 2.88%, 3 year 13.22%, 5 year 11.88%. It leans heavily on large cap stocks, making it a relatively stable option compared to pure mid or small cap funds. Its portfolio is dominated by leading banks, supported by aerospace, chemicals, and IT sectors that provide both cyclical growth and defensive strength. Performance-wise, the fund has consistently outperformed its benchmark over 3 and 5 years, even though the 1-year return is slightly negative. The low portfolio turnover and lowest volatility among peers highlight its disciplined approach. Moving on, Kotak Large and Midcap Fund. AUM 27,372 crore rupees. This fund includes HDFC Bank, State Bank of India, Bharat Electronics, ICICI Bank, and Eternal as their top 5 holdings. CAGR returns of direct plan growth option are for 1 year 1.48%, 3 year 16.65%, 5 year 15.15%. This scheme offers a balanced mix of large and mid caps, with banks forming the backbone of its portfolio. It has consistently outperformed its benchmark across all time frames, and also delivered alpha while maintaining moderate risk. It also has exposure to pharma and IT, which adds defensive strength. Now, Kotak Multicap Fund. AUM 22,095 crore rupees. It includes Maruti Suzuki, Hero MotoCorp, Indus Towers, IndusInd Bank, and NTPC as their top 5 stock holdings. CAGR returns of direct plan growth option are for 1 year 3.44%, 3 year 21.58%. We don't have 5-year data as scheme allotment date was September 29, 2021. This scheme spreads investments across all market caps, giving a diversified flavor. Recently, it has delivered some of the strongest returns among Kotak's equity schemes, making it attractive for those seeking upside. Finally, Kotak Small Cap Fund, AUM 15,157 crore rupees. Stock holding includes Aster DM Healthcare, Sensera Engineering, Krishna Institute of Medical Sciences, Vijaya Diagnostic Center, and Century Plyboards. CAGR returns of direct plan growth option are for 1 year minus 6.66%, 3 year 12.86%, 5 year 14.18%. Compared to the benchmark Nifty Small Cap 250 TRI are for 1 year minus 4.86%, 3 year 18.30%, 5 year 16.34%. This fund is highly aggressive with nearly 80% exposure to small caps. While it has underperformed its benchmark over 3 and 5 years, this is typical of small cap cycles where volatility is high. Its portfolio is healthcare heavy, supported by consumer durables and auto components.
CAGR returns and benchmark comparison. When we look at CAGR returns, Kotak Midcap Fund outperformed benchmark in 1 and 5 year horizons, slightly lagged in 3 years. Kotak Flexicap Fund consistently beat benchmark across 3 and 5 years, showing resilience despite modest absolute returns. Kotak Large and Midcap Fund delivered alpha across all periods, especially strong in the short term. Kotak Multicap Fund, clear winner in the 3-year horizon, significantly ahead of benchmark. Kotak Small Cap Fund underperformed benchmark in 3 and 5 years, reflecting small cap volatility. Let's first understand what this ratio means. Portfolio turnover ratio measures how frequently the fund manager buys and sells securities. High turnover means more actively managed. Low turnover means stable portfolio, as there is low churning in portfolio. Standard deviation, which also means volatility, indicates how much the fund's returns fluctuate compared to its average returns. High standard deviation means more volatile, higher risk. Low standard deviation means more stable, predictable returns. Beta measures sensitivity of the fund to market movements. Benchmark equals 1. Beta greater than 1, fund is more volatile than the market. Beta less than 1, fund is less volatile, defensive in nature. Sharpe ratio shows risk-adjusted returns, return earned per unit of risk. Higher Sharpe ratio, better compensation for the risk taken. Lower Sharpe ratio, weaker efficiency, returns don't justify risk. Now let's check how the funds has performed. Flexicap Fund, lowest volatility and weaker Sharpe ratio. Returns are not as efficient. Midcap Fund, moderate volatility, decent Sharpe, aligns with strong long-term returns. Large and Midcap Fund, balanced risk but weaker Sharpe ratio, meaning returns are not as efficient. Multicap Fund, highest turnover and beta, aggressive, actively managed, more sensitive to market swings. Small Cap Fund, most volatile with weakest Sharpe ratio, high risk, poor recent risk-adjusted returns. Final thoughts. So what is the big takeaway? Each Kotak Equity Mutual Fund brings a different flavor to the table. Flexicap offers stability, Midcap and Large and Midcap deliver balanced growth, Multicap provides aggressive upside, and Small Cap carries high risk potential. The key is not chasing a single best option, but understanding how performance, portfolio allocation, and risk metrics vary and aligning them with your long-term goals. Remember, wealth creation in equity funds is about discipline, patience, and compounding over time. If you found this helpful, subscribe for more smart investing insights, and don't forget to check out our blog for detailed fund reviews and insights. Until next time, invest wisely, stay disciplined, and let compounding work for you.